Okay, welcome back. We had discussed about initial measurement for PPE. Now I'm going to move to the next part, that is subsequent measurement or measurement subsequent to the initial recognitions. Okay, under IAS number 16 as well as ASB number 116, it allows us to choose either using the cost model or revaluation model. So I'm going to explain what is cost model and revaluation model. But please remember, if you want to, you cannot apply this model to individual asset. If you choose cost model, the entire PPE must use cost model. But if you use a revaluation model, the entire class of PPE must use revaluation model. So this is what cannot be applied selectively. You cannot choose for this asset, I'm going to use revaluation model. For another PPE, I'm going to use revaluation model. It cannot be happen like that. Yeah. Okay. So what is cost model? The cost model is very easy. This is what we normally did. Require that asset be carried at cost less any accumulated depreciation. We have asset, cost, and then we're going to minus depreciation or impairment loss. I normally use IL, impairment loss. What is the value of this asset? Cost minus accumulated depreciation minus accumulated impairment loss. So every year, the value of that asset will reduce. The value of this PPE will reduce. So the cost incurred at the time the capacity is changed must be able to be measured reliably. So we have depreciation. Okay. So under cost model, we have depreciation. So what is depreciation? Depreciation is just a systematic allocation of depreciable amount over assets useful life. For example, if you have a delivery van that you purchase at price of 50,000 and this asset can be used for 10 years. Even though you paid 50 million today, but the benefit is for 10 years. The benefit can be enjoyed for 10 years. So what you need to do is you allocate the cost. You distribute the cost for the period of 10 years. So every year you have depreciation for that asset. You don't put the 50,000 in the profit and loss of this year, but you're going to share the 50,000 cost maybe evenly, or you have some other formula for every financial or every profit and loss for 10 years period, for the useful life period. So that is the concept of depreciation. We don't want to put that asset 100% as our expense in year of purchase, but we allocate the cost. Okay. So then we come up with this depreciable amount is the cost of asset less residual value. So this is depreciable amount, cost minus residual value. So this is the depreciable amount that will be depreciated over time. Okay. Okay, next is what is residual value? Residual value or scrap value is what value entity estimate they are going to obtain when they dispose the assets. Okay, for example, maybe in that case of delivery, when if you dispose the asset, you can sell it to the scrap dealer, yeah, maybe at a price of 500 dirham or $1,000. So that will be the scrap value. Even though the asset cannot be used anymore, you can still sell it for to be recycled and so on. So that will be the residual value. Next one is the useful life, is the period for which the asset is expected available to be used by an entity. And it vary between different type of assets. It vary between different types of assets. Okay. So let us look about depreciation. I did mention is about allocation of cost over a period of times. Okay. So depreciation is just a process of allocation. Yeah, it does not measure the real change in value. It's just estimation, yeah, estimation. AASB 116 or IAS number 16 does not specify how this allocation process should be undertaken. You did learn during your EK 112 several techniques of calculating depreciation. For example, the most common one will be the straight line method. You have declining or diminishing method or reducing balance method. We call it reducing balance method as well. And then we learn about sum digit method, or maybe based on productions hours method. So there are many methods to calculate depreciation. So this accounting standard does not specify you must use method A, method B, or method C. So it's free for you to choose which method, yeah, provide more suitable for your type of assets. So the most common one is straight line method. What is the formula? Cost minus residual divided by estimate useful life. Example, the cost is 100,000. Okay, the residual value is 5,000. Can be used for 10 years. 10 years. So every year your depreciation will be every year your depreciation will be 9.5 thousand. 9,500. So this is the formula. Cost minus residual value divided by useful life. Cost minus residual value is depreciable amount. So this is depreciable amount. Whereas for diminishing balance method, or also known as reducing balance method or declining method, the amount of depreciation is much bigger in the early years of the asset's useful life, and the amount will decline. The amount of depreciation will decline over time. Yeah. So we record big amount of depreciation in the first few years and low amount of depreciation at the end of the useful life. So we also have a unit of production method based on the output. Yeah, based on the output, we did discuss this. Yeah, and we also have this useful life. So how to determine useful life is depend on the entity estimation based on their experience. Okay, how long this asset can be used. Okay, residual value, we did mention this is the value based on the expectation of the entity, how much they're going to obtain from when they dispose its assets. Okay. Okay, the next one will be the significant part depreciation. This approach requires an entity to allocate the cost of assets to its significant part and account for each part separately. For example, in the case of airplanes, yeah, maybe the engine, we need to provide depreciation for that engine, depreciation for the body of the aircraft, depreciation for the navigation system, because these are the significant part. Maybe the cost of the airplane one aircraft is 200 million. Maybe I don't know. I don't have any idea about that. Maybe 30% or 40% goes to the engine. So this is the significant part. So each part will depreciate separately. So each part is depreciated separately for significant part. And the balance or any remainder also depreciated separately. Okay. Okay, let us look at this example, example 5.6. This is example from the textbook Loftus. Yeah. Swift Limited purchased a delivery vehicle which is serviced annually at a cost of 1,000 per annum. Okay, so this is the service cost. Yeah, 1,000 per annum every year. After 5 years, the following amount were paid as part of the service cost. Okay, after 5 years, year 6, we need to pay annual service cost of 1,200. And then we need to fix the rear bumper due to accident. That costs us 700. And we need to change the existing engine with a new one of increased capacity. So we need the engine that cannot work anymore. So we need to put a new engine and it will increase the capacity of this vehicle. So we have three type of cost here. Number one is the normal service cost. Number two is the repair cost. This is the repair cost. Number three is you want to upgrade your engine, increase in capacity. This is you upgrade your engine. You upgrade your engine. Okay. So how are we going to recognize this? Is this going to be your expense, or is it going to be your assets? Yeah. So advise Swift Limited which amount should be expensed and which amount should be capitalized. So amount of 1,100 would be expense. This 1,100, the 1,200, and also the repair cost will be an expense. Expense means it go to profit and loss. It go to the income statement. Okay. However, the amount of 2,700 would be capitalized as asset. So this one, if you have your PPE here, capitalized means you're going to add on the debit side. So you're going to debit the PPE by 2,700 because it comprised of the new engine, improve its capacity, and so on. So it's going to be 2,700 debit vehicles or delivery vehicles there. Okay. This is example how to calculate depreciation using straight line method. So in this example, we have planned cost 100,000. The received value is 10,000. So the asset can last for 4 years. So what is the annual depreciation? So cost minus residual value and then divide by useful life. So every year, this asset will depreciate by 22,500. Okay. Let us go to this example here, this answer. So originally the cost is 100,000. For the first year, it's going to depreciate by 22,500. So our accumulated depreciation from zero now become 22,500. So cost minus accumulated depreciation minus will give you your carrying amount. So now what is the value of this plan? The value of this plan is 77,500. So that is for first year. For second year, since we are using the straight line method, next year the depreciation still 22,500. So our total accumulated depreciation becomes 45,000. So from your 100,000 cost of asset, 45,000 already depreciated. So the carrying amount value is only 55,000. The carrying amount value is only 55,000. So, and this continue until at the end of year 4, the value of this asset, the carrying amount will be 10,000. That is your residual value. So what will be the journal entry for every year? Debit, depreciation expense, credit, accumulated depreciation. Debit, depreciation expense, credit, accumulated depreciation. Yeah? Okay, for diminishing balance method or straight line method, this is the formula. If you're not given the rate, this is the formula. 1 minus, and here this is the useful life. Okay, R is the residual value, and C is the cost or other revalued asset. So it will be 1 minus, this formula, and then you get 44%. So this is your depreciation rate. 44% based on the carrying amount, or net book value. So what happened is, in the first year, our depreciation will be 44,000. So cost minus accumulated depreciation, our accumulated depreciation will increase to 44,000. So our carrying amount will be cost minus cost minus accumulated depreciation, that give you 56,000. So in the second year, your depreciation, the 44%, is calculated based on this carrying amount of previous year. So, this 24,000, this 24,640 is equal to 44% multiplied by 56,000. So that is how you get this figure 24640. Okay, I'm sure you aware that the depreciation amount reduced significantly over the time, yeah, from 44, 24, then 13 to 7. Compared to the straight line method, the amount of depreciation is fixed over time. So this one, in the first year, the depreciation is 44,000. Second year, 24,000, 13,000, and 7,000. Debit depreciation, credit accumulated depreciation. Okay, so I want you to go back later on with this part. This is your responsibility. I want you to go to example 5.8, page 156 and 157. Yeah, please do your revision on these topics.